Yeah, can we point this any direction, or is it a?
I think so.
Okay.
Yeah, that works.
Okay, thank you all for being here today. We're from Montana State University and we're presenting Hecla Mining Company. We recommend a buy rating with a 12-month target price of $8.21, which is 27% upside. We give this recommendation based on Hecla being the industry low-cost producer with an after byproduct cost of $3.68, which is 35% of the cost of their average competitor. We also believe the market is underpricing Montanore and Rock Creek. These projects are expected to double silver reserves and production. In addition, they have shown their commitment to safety by being the first ever hard rock miner to get the core safety certification, which means they had 0 fatalities and displayed worker safety improvement. If we look at the macroeconomic outlook, demand for silver, solar PV cells, which are the second largest industrial use of silver, are expected to grow by 40% in 2017. And I'll now hand it over to Sarah for a business overview.
Thank you, Emily. So to begin our business overview, we prepared a quick map for you to see the locations of the 4 operating mines of Hecla, as well as the 2 pre-development projects of Rock Creek and Montanore. We have prepared the revenue per mine figures for you. As you can see, Grease Creek has the highest percentage of revenue per mine. It is the biggest silver mine in the United States. We would also like to note that Lucky Friday has just undergone a 34-year life extension and has been in production for 58 years. Next, we will talk about the revenue per metal. As you can see, about 47% of Hecla's revenue comes from silver. There's such a high proportion from gold because of the market price per ounce for gold. Hecla is the largest silver miner in the United States and the 3rd largest producer of lead and zinc in the United States. Next, I'll briefly talk about management and governance. This is the current CEO and president, Mr. Baker. He had under his tenure, there's been a 791% increase in asset value. The board members recently took a 10% decrease in salary and set off a tone of austerity within the company during a time of weak metals cost. Additionally, management has the goal of being the S&P 500, and to do this, they would have to increase about 2-fold their current market cap. So long-term growth would be necessary there. All board members but Mr. Baker are independent, and also Mr. Baker is not the chairman of the board. Next, I'm going to pass this over to Nate, who will discuss the industry overview and competitive position.
Thank you, Sarah. This chart demonstrates silver demand increasing while the price appears to be going down. However, increase in demand puts more of a floor on price and actually creating dramatic price swings. Silver's primary uses is industrial with electronics, PV, and photography making that up. Electronics and solar are expected to increase over 2017, while photography is expected to continue to decrease. And silver's other uses are coins and bars and jewelry. As of 1/31, silver price was $17.51. Hecla also has significant exposure to gold, and gold's uses are primarily jewelry and then investments and industrial uses. Gold's price as of 1/31 was over $1,200. Hecla's annual silver production for 2015 was a little bit under 12 million ounces, but for 2016 it was up to 17.2 million. Hecla is the 19th largest silver producer in the world and the largest in the United States. Its acquisition of Montanore and Rock Creek, when they're both online by 2024, are expected to contribute an additional 8 million ounces a year apiece. Hecla has the lowest cash cost out of all of its competitors at $3.68 an ounce in Q3 of 2016, and for 2015 it was $5.85. It has significant zinc and lead reserves in its mines, which it sells along with gold in order to get to that non-GAAP measurement of cash cost. Hecla's silver reserves are expected to grow 260% or 460 million ounces with the acquisition of Montanore and Rock Creek. Hecla has used a prudent amount of leverage and issued common stock in order to make the acquisitions up to this point. It has, before 2012, after 2012, it's doubled its gold reserves through the purchase of the Casa Berardi mine, and even though silver reserves have moderately declined due to depletion. Now with the financial analysis, Hecla sits in the middle of its pack with a 2 for its current ratio. However, it has access to a $100 million line of credit that it's left untapped. Hecla's been utilizing its free cash flow in order to finance a $225 million Lucky Friday number 4 shaft, which has significantly expanded the life of that mine, $900,000 plus stock for the acquisition of Rock Creek, and $4 million plus stock for the purchase of Montanore. Hecla has a 0.4 debt to equity ratio, which is much lower than Core and Silver Standard. Core has actually been forced to liquidate some of its assets in this time period that Hecla was purchasing underpriced assets. That $500 million increase was to purchase the Horizon's Casa Berardi mine in Canada, which more than doubled gold reserves. This graph demonstrates the issuance of shares and debt in order to increase assets. However, most of this has come through share issuance, but it hasn't depleted gold reserves per share. Mineral reserves per share. Hecla's first year for free cash flow after the spike of 2011 in gold prices has been 2016, and it's done very well. It's had significant capital expenditures into the number 4 shaft at Lucky Friday, at San Sebastian to open it back up, and with Casa Berardi. Gold had a high price of $46 an ounce in 2011 due to the Eurozone crisis, and a low of $14 in 2015, which is a 70% decline. Now I'm handing it off to Cody for valuation and investment risks.
Thank you, Nate. Our first valuation method is multi-step discounted cash flow. This chart right here represents the forecast for cash or revenue over the next 8 years. We also factored in the changes in CapEx with the addition of the 2 new pre-development projects. Our factors for weighted average cost of capital were mostly teammate estimates, but there was also company provided data here. In the end, our weighted average cost of capital is 8.28% with our discounted cash flow target price of $8.21. Our next step was a comparative market valuation approach. And you can see right here that this is the price that you pay per silver ounce of reserves that Hecla has. Under their current reserves, you can see that they're about in line with their competitors. However, under the inferred reserves, you can see that when Montanore and Rock Creek are added in, it's significantly less expensive per silver ounce. Here we also demonstrate the increase in silver reserves. As I mentioned earlier, it would be about 200% increase in silver reserve with the addition of those 2 mines. These are the other 4 metrics we use in this comparative valuation. Cost per silver ounce, as stated earlier, is pretty prominent here, $3.68, and that makes them the industry low-cost producer. The target price there was $8.24, which was about in line with our discounted cash flow price. Our total target price was $8.21. Then the risks to this valuation are shown here in this graph. This shows 2. As you can see, Hecla matches, for the most part, what silver does in terms of price changes. However, here in 2011, 2012, this is where they began to experience mine safety issues, and Lucky Friday was closed down due to these issues. In addition, we've seen a tightening of the labor market in North America since the recession, and if this continues, HECL will be required to pay more to their employees in order to retain them. At this time, and we'd just like to reiterate that we have a buy recommendation with a target price of $8.21. This is supported by the fact that they're a low-cost producer. They're going to experience massive reserve and production growth with pre-development projects, and we believe that those are priced at an extraordinary discount. At this time, I'd like to thank you all for being here and open it up for questions.
On your first comparative valuation slide.
Yes. Oh, yeah. Yes.
So here you're saying that each share you buy has what? With the current and inferred reserve, something like $19 of reserve value?
Well, can you repeat that? Sorry.
So is this chart here on the left-hand side showing for each share the dollar value of the reserves behind that?
Yes.
Okay. And so then if that's the reserve, you're saying it's 368 per ounce. I guess why isn't your target higher?
It's a good question.
It's better to meet target or exceed target prices later than meet them now.
And also you can only extract so much silver per year. And you couldn't extract all of that at once, and so it is going to have to be extracted over time. And just like with the Lucky Friday mine, the $225 million shaft they just put in has expanded the life or the mine's life by 34 years. So.
And with the inferred, is that 100% of the inferred that you've added in to get to that?
This is
Or did you
100%.
risk adjust it?
This is just 100% of the inferred
Okay.
from Rock Creek and Monmouth.
Okay. So less of that could be realized.
Not historically with this company. They've done a really good job with not only reaching their reserve goals, but exceeding them significantly.
I know you guys seem like you did a lot of your work based on cash costs. Did you guys also look at all-in sustainable costs?
I did, and that was right around $34 an ounce, and it seemed pretty consistent for the last 3 years.
$34 an ounce?
But that was without considering, all of the sale of gold, and that was just for their silver revenue. Yes.
So the other question I had is, so I'm a little bit confused in terms of there's, you guys cited like a 40% increase in solar demand going forward.
Yes.
But I think it's my understanding that like in 2015, 2016, industrial demand has actually been down. Why is industrial demand decreasing if solar is going so gangbusters?
Well, solar is actually held kind of steady, and it's even dropped over the last year, but it's expected. Silver Institute is projecting it growth of 40%, and everybody's expecting more use of electronics because of so much more electronics being used, in the third world countries. Everybody has a cell phone or, something, and they're expecting higher market penetration in that with those type of
In emerging markets.
Yes.
So with them doubling capacity with their 2 mines coming online, how will that affect the silver prices? Is it significant enough that it'll change the supply demand dynamic?
I think that the majority of silver prices is due to people trying to hedge against economic uncertainty, because even as you've seen, demand has gone up and up and up, and price has gone down.
Do the commodities usually do better in a hyperinflationary period or a deflationary period or no inflation? Like, what's the ideal economic backdrop for gold and silver to screen?
Gold and silver, for that, it would be more the crisis. And so they tend to do better in deflation because there's a lot of uncertainty.
So it did well in the Great Depression. Gold did well in the Great Depression.
But they also rise in value during hyperinflation because it's something that there's only a certain amount of value or a certain quantity of available, and you can't produce that much more to swing, increase the
So it
quantity.
works well on both tails.
Yes.
For your DCF, what assumptions did you use around commodity pricing?
On commodity pricing, we expected that it would increase with inflation.
Based off of spot today.
Yeah, based off of the spot. Based off the spot from when we wrote the paper.
for their capital structure, you didn't see, did you feel like it was a good balance between debt and equity, the way they had financed the acquisitions in the past, or did you see any cause for concerns there?
I thought that it was a good way of doing it because they weren't depleting silver reserves per share through the share issuance, and they haven't taken on so much debt that they can't survive through low silver prices.
So you showed it. I think their debt being less than industry competitors. Should they be actually increasing their debt so that you get higher returns to the shareholders?
I think that they should keep debt where it's at, or perhaps even pay it down, because they want to be able to survive through the low cost, or through a low price environment, and they're the low cost producer. So it's nice to be able to use debt when the market is or underpricing assets, so that you can mine them and sell them when the market is up.
Did you guys look at all in terms of like management team, in terms of insider buying or selling at all?
We briefly looked at it. Do you have a specific question about it, or
Just whether or not the management team, the CEO, CFO, been recently been buying the stock or they've been selling it. Sometimes that's a pretty good indicator in terms of their belief in the company and where it's going.
Right, we briefly looked at that, and there is activity both buying and selling. I don't have the specifics on that. There is activity on both buy and sell.
How did you decide on your peers that you decided to compare Hecla to in your competitor analysis?
What we did is we tried to find peers that were similar in size on both the large end and the small end. We tried to kind of get somewhere where it would kind of be it would average out to being about the same.
With so much exposure to commodity pricing, do they do any hedging to lower that volatility?
They do hedge their byproducts, but they like the exposure to silver prices and gold prices, so they don't really hedge those.
And how about any currency risk then, since they are multinational?
They sometimes hedge currency as well, but not very often.
And of course, there is going to be that currency risk in terms of, especially like moving forward into the future, if there's going to become issues with international trade between America and other countries.
And especially because they have so much of the revenue coming from the Casa Berardi mine in Canada. And if something were to happen to the NAFTA trade agreement, there could be an issue.
So has the strong US dollar hurt them in the last couple of quarters?
Revenue from San Sebastian has been pretty good because of the peso being down.
But they haven't actually cited the US dollar hurting them from a profit standpoint.
I didn't see anything else.
We can get back to you on that.
When you took a look at the board composition, did you take a look at diversity of skill set or backgrounds? Were there any cause of concern there, or points of interest?
There was a lot of people from Barrick, yeah, which it's a different mining company, but it's a good mining company. So
Barrick's larger than Hecla, correct?
yeah,
Considerably.
Did you do any sensitivity analysis around, if there's a huge swing in metal prices, either upwards or downwards, how that would affect your target price?
we did not.
Yeah, I think that's it. Great presentation, guys. Thanks very much.
Thank you.